Powell just hinted that QT may be ending, and Wall Street is foaming at the mouth. But ending QT isn't a rate cut. It's just the Fed trying not to break the plumbing. Here's why that subtle shift matters more than you think. What did he just say? Chairman Powell, said something about ample reserves. Was he hinting that there were not enough reserves in the banking system to avoid liquidity challenges? All right, I'll stop beating around the bush and I'll get straight to the point. Powell implied that the Fed may be approaching an end to quantitative tightening, or QT, in coming months. Now, this is a bit of a tricky topic, and I know it makes eyes glaze over, but stay with me. I'll try to explain. The market, you see, is thirsty for Fed easing. So this little comment from Powell got everyone buzzing, at least in the econ nerd crowd. Let's unpack what it means and why it even matters. First, what is quantitative tightening? Well, QT is the Fed removing liquidity from the system. In practice, the Fed lets its treasuries and mortgage-backed securities run off or sells them in the open market. When a private investor buys those securities, cash leaves the system. Less cash means higher yields. Higher yields mean the Fed is pressing on the brakes. The opposite is quantitative easing, or QE. That's when the Fed buys treasuries and mortgage backs, paying cash and adding liquidity. That pushes yields down. QT is draining the pool and QE is filling it. Now, fast forward to 2020, the pandemic era. Remember that? Well, the Fed slammed on the QE gas pedal to save the economy. Its balance sheet exploded. That balance sheet is called the System Open Market Account, or SOMA. And yes, it still looks bloated today compared to pre-COVID levels. When the Fed began QT in 2023, it wasn't selling securities outright, it was letting them run off. When a treasury matures, the treasury pays the Fed back, and that money vanishes from the system. Bank reserves fall. It's quiet tightening. No traders even needed. Now, Powell says ample reserves. That's the Fed's favorite fuzzy words. Ample means enough for the banking system to function smoothly. If reserves drop too far, funding markets get a little nervous. That's kind of what happened in 2019 when repo rates spiked and the Fed had to step in. You probably don't remember that, but I do. Powell certainly does, and he doesn't want a repeat. You can't stop a treasury from maturing, you see, and time keeps marching on. So ending QT really means that the Fed start reinvesting maturing proceeds into new treasuries. That keeps the total holdings flat. It doesn't expand the balance sheet, but it stops it from shrinking. Think of it as turning off a drain, not turning on the faucet. But here's the twist. Most of the Fed's runoff has been in short-term treasuries, bills, 2s, 3s, and 5-year maturities. That's because longer bonds don't mature for years. That's kind of how time works. And mortgage-backed securities, well, they're barely moving because nobody refinances a 2% mortgage. So the pressure is all on the front end of the yield curve. When QT stops, the Fed will likely reinvest in T-bills, not long bonds. That means short-term yields drop slightly. The repo markets can breathe and money markets relax a bit. But long-term rates, the 10-year, 30-year, mortgage rates, they won't move much. They're driven by inflation expectations, deficits, and global demand for U.S. debt. Recently, we've seen signs of stress. The effective Fed funds rate is hugging the top end of its range. Overnight repo rates are rising. And that's the market telling the Fed liquidity is getting a little tight. Not a crisis yet, but it's a yellow flag. Some of it is banks hoarding cash because they're a little nervous, and some of it is just QT finally biting. When reserves fall, banks would rather park cash at the Fed and earn interest rather than lend it overnight. That shrinks liquidity even more. It's a self-reinforcing loop. Powell's ample comment signals that he's watching that very, very carefully. That's his job. It was a warning shot, disguised as technical jargon. If the Fed adds runoff, bank reserves stabilize. Short-term yields fall a bit and repo rates cool off. Financial conditions loosen slightly, but that's not a pivot. It's not easing. The Fed can halt QT and still keep rates restrictive. This is a separate lever. balance sheet management versus policy rate. Ending QT is about plumbing, not policy. Think of it like adjusting water pressure without changing the temperature. So, will this help markets? Yes, to a degree. It removes uncertainty. It tells investors that the Fed doesn't want to break anything. It helps front-end volatility cool a bit, but it won't fix mortgage rates. It won't magically lower your credit card APR. It just keeps the system breathing. In summary, ending QT is the Fed's way of saying we've done enough tightening in the background. It's a technical step, not a policy shift, and Powell knows it's time to be careful. You don't want to accidentally spark a 2019-style funding crunch when markets are already a bit edgy. So the next time you hear someone say the Fed is done tightening, ask them which kind, rate tightening or balance sheet tightening. They're not the same. And right now, the Fed is just trying to keep the pipes from clogging. So your truth bomb for today is this. Ending QT isn't easing. It's just the Fed turning off the drain before the system runs dry. Join me every day for Wall Street Truth Bombs, where I drop them here before the market figures them out. Thanks for checking in with Wall Street Truth Bombs. Remember, we drop them here before the market figures them out.